name's Scott Borowski. We have basically a summit that we've built. It's called Riverside Angel Summit. The idea of it is that we in our inland Southern California region have been helping startups raise capital. I'll get to this in the next slide, but we've had a real challenge getting early checks written in our region. And so for Riverside Angel Summit, what we're doing is we are working to identify mostly investors who haven't invested in tech startups before. And we are not only as part of this process doing workshops like this for entrepreneurs, we're also doing workshops for investors to teach them how to do due diligence and invest in tech. And so I think it's gonna be a great thing for the region. And we're lucky to have an amazing panel today, which I'll get to in just a second. But this is kind of how we work as a program. Our program is at UCR. It's called EPIC SBDC, which stands for Small Business Development Center. And what we do is we basically take startups from in the lab or in the community, and we help them basically scale with talent, starting the company if they're coming out of the lab. And then we help them raise both non-dilutive capital in the form of grants and SBIR, STTR funding, as well as early capital in the form of either angel capital or seed stage capital. We also have several of our startups that have raised seed stage capital that are now raising Series A, and they have asked us to help them. I wasn't really planning on having that happen, but that's kind of what's going on. So this is our process, just so you know. And this is kind of what's happened in the region. And I know that, this is like, 17 million is like a slow day on the coast in LA in terms of capital raised, or in San Diego. But for us, for our region, it's a big deal. When I first launched this program in 2018, I didn't have any deals that I would feel comfortable introducing to my venture or angel contacts. And just in the last year, and this actually needs to be updated, we've raised a few more million since I created this slide a couple months ago. But in any case, you can see that the region is starting to have some investable deals, and that's a good thing for inland Southern California and Riverside region. This is our amazing panel. So we're going to take a few minutes to let them introduce themselves. We're also going to have them give you a little sense of what they're looking for, which for those of you who are first-time founders is called their investment thesis, as well as when they like to start making investments. So that would be the stage that they like to be involved in potential deal introductions. So let's kick it off with Z, and then we'll go to Michael and then Peter.
Great. Okay, I'm really distracted by my picture. I have no idea where you found
that's from your website, the corporate website. Sorry about that.
Oh my gosh. Okay, then I have to have a conversation with them.
Yeah, sorry. I should have gotten gotten one from you.
No, yeah. I know. No, anyway, really nice to be here. Very excited to chat with you and the audience here of eager entrepreneurs. And I'm a venture partner with Good Growth Capital. We're an early stage fund, and we focus on complex science and technology startups, anything from pre-seed to Series A, and we'll be talking later about what that means. But I would say our investment thesis is really around, we like to look at kind of untapped, undervalued, very highly technical deals that generally tend to be very hard for most VCs to diligence, because we have a team and an extended network that has really deep knowledge in these technical fields. And I myself am an engineer, and most of us are engineers, and also networks and industries. And also we all have very strong operating experience. And so we really work early to cultivate the founders and the startups. And so that even though we're a smaller fund, we tend to get really great allocations in later rounds as a result of the support that we provide and the fact that we kind of discover these deals.
Very cool. Michael?
Hi, yeah, thanks for having me. I am also an Angelino and grew up in the IE, so very excited to see the progress in the ecosystem. But I'm still currently based in LA. I've been at Craft for almost 3 years now. We are also an early stage fund, focused really seed to growth. So early stage, I guess, can be relative, but check size below $1 million, upwards of 50 million, depending on the round. We can lead, we can follow. Sector agnostic, and predominantly focused, however, on B2B SaaS and marketplaces. Everybody here is a former founder and or operator, and so that's what's driven the areas of focus. And we have a growing operating partner team as well. to augment the support we provide the portfolio. So yeah, so that's a quick high level, and very, very excited to learn more here.
And also, I'll just say, since you're not going to say it, congrats on, I believe you just raised a $1.1 billion next fund. So congrats on that.
Thank you. I will take it on behalf of our COO and GPs who spent most of the time fundraising. Appreciate it.
Okay, cool. All right, cool. Peter?
Yeah, thanks for having me. So my fund called Embark Ventures is actually probably similar to Good Growth Capital, where Z is at. So we do seed stage investing in what we call deep tech startups. So we focus on companies that have more defensible proprietary technology at its core. I spend a lot of time in robotics and manufacturing. My partner does a lot in like material science and chemistry. We're LA based. We do pre-seed and seed. We have almost half of our companies in our portfolio are university IP spinouts. So we spend a lot of time looking at core tech coming out of labs, and the rest are spinning out of industries. We have a number coming out of SpaceX, things like that. But we invest nationally. We do a lot of hardware, though it's not a requirement. It just ends up being that a lot of the deep tech companies we invest in have a hardware component. And yeah, I think that covers it.
Okay, cool. And Z, you wanted to add a couple of things?
Well, I just was thinking, both neither Peter and I mentioned the average check size. So
yeah, that'd be great.
Might have
Actually,
been helpful. Actually, sorry, we tend to be somewhere in the kind of 300 to upward, like up to 2 million, but generally our sweet spot is around 500 or 750K. We have two different fund families we invest in, and we won't do things like a lot of deep consumer, kind of something that takes a lot of branding, your app, internet, without a lot of proprietary marketplaces. If you're raising for that, don't come to us.
no, that's good. And that's something that we'll get to a little bit later too, probably more detail, but I just we do have a lot of first-time founders not just in our region, but in Southern California in general. And that is something that, we always suggest that the founders do the work and do the research before you talk to an investor, because you don't want to waste your time on going to try to connect to investors that don't invest in what you have built, whether it's a product or service or whatever your startup is. And so, yeah, definitely do the research. And we have an entire other workshop series we did on that, on how to build an investment strategy and raise your early capital rounds. And I can point you to that if you want to send me a note later. That's going to be a YouTube video that will be up in a day or so. Okay, cool. Well, let's just dive into the questions.
Wait, we didn't hear Peter's check size.
Oh, sorry.
Oh, yeah.
Peter, check size.
Yeah, so average check size for us is 750K to $1 million. Our range is about 250K to 2 million.
Okay, cool.
And we're similar. We focus almost primarily on industrial tech. So we don't really look at consumer a lot.
Okay.
Peter and I need to be doing more co-investing together.
I agree. Well, honestly, that's one of the reasons why we like to do these type of events, these workshops, because we also, the same things going on with our as I said, our very early angel community. Most of the high net worth folks in our region don't know each other. And so it's been good with this. We put together what's called a special purpose vehicle called Citrus Seeds. And that group is a group of investors that are coming together to invest in the eventual winner of this Riverside Angel Summit process we're in now. They'll do the top 6 will pitch for basically the investment. But let's get into some kind of, I guess, maybe higher level discussion just around investment in general. Obviously, I think we've all seen these type of headlines if we're interested or involved in the tech startup world. This is from our friends at Crunchbase. So funding hits all-time high. There's a lot of these headlines. I think what happens for a lot of founders, especially first-time founders, is they underestimate how hard it is to raise capital. And what I'd like to do is spend some time with the three of you, with the panelists, kind of talking about not only more details around how you think about investing, but also I want to get to some traction discussion as well, so that some of the founders understand what traction means and what it means to, be ready to raise either a pre-seed or a seed round, or be ready to raise a Series A. So let's kick into that. So I guess the first thing is, I think that's some founders don't get is how much deal flow great VC groups like the three of your teams see. And so maybe we can have a quick discussion just about how you filter, what you do with cold emails you receive, those kind of things for the founders, so they can kind of understand maybe why they don't get a phone call back from you right away if they send you a random email or something like that. So let's talk about how you filter your deal flow. Anyone can start.
Well, I'll validate that we get thousands of deals a year, and it won't be surprised that anytime I get an intro from someone I know, it will be easier to get me to consider it, to look at it, just because, I see the name, right, that I know. That said, because we really do value, we see the opportunity in deals that other people might be passing up. We try to be really cautious about not just ignoring and requiring an introduction, because then it's all based on network. And then those, we like to turn over rocks that other people aren't necessarily turning over. And so, but I think that the best way to get my attention is to make it really clear, very concisely, what it is that what the opportunity is and why it fits with. You don't have to make the argument that it fits with my investment thesis. However, it needs to be very clear by what you're presenting that it is part of, it does fit with the investment thesis, and that it's a big market opportunity. You have something, in our case, proprietary and a really unique perspective, and that you have a strong team, or at least you're really aware. We'll talk about all those different things, but just really concisely to talk about those things. And it needs to be in the sweet spot, because if it's not, we have LPs that we are investing on behalf of. So we can't be I can't spend my time looking at deals that are not relevant to our.
So for those first-time founders who don't know what an LP is, can you just give a quick definition of that?
Sure. So investment funds, venture funds are, we as partners, we may put our own money into it, but it's primarily, the fund is funded by limited partners. So those are partners that don't make investment decisions, but they're investing money with us in our fund so that we can then invest it on their behalf. So we have a fiduciary responsibility to those investors to make sure that they get the best return possible. And the return, in some cases, impact funds may have multiple bottom lines, but anyway, so return, and also that we fit within a particular investment thesis that they bought into when they made the investment, and we made the pitch to them for them to invest in us.
Great. Peter, you want to add any thoughts on how you filter your deals?
Yeah, similarly. So our fund is pretty focused, and if you go to our website and our bios, we're pretty clear on what we do. So the biggest filter is, there are some entrepreneurs who just don't necessarily do the homework to check what we do. In the realm of hard tech investments that do fit our thesis, Z hit it right on. If it's coming from a trusted source, portfolio company executive or CEO or founder, or another investor that we trust, generally we'd at least take a first call or a meeting. When something comes completely over the transom, I don't know, I would probably put it at 1 out of 20. I might take a call because a lot of them just aren't a fit. But for me, I spend a lot of time in robotics, probably about 80% of my time. And so if it is a robotics company that comes over the transom, I probably will take a look at it, just because that is more interesting to me. But I think the most important thing is to do your homework on stage and fit first. And then, all the things around, once you get my attention to, what's the value prop and what's the pain point you're solving. Don't be completely tech focused. What's the market asking for and why is this important? So all the general stuff you look for in team, market, product, things like that.
Okay, cool. And we got some questions. We're going to dive into each of those in just a sec. But Michael, you want to give us any thoughts on how you all filter through the deals? I think again, I'm not exactly sure, but I think you guys have about 2 billion under management. So I assume you get quite a few deals in as a firm. So any thoughts on how you filter?
Yeah, similarly to what Colleen and Peter called out, similar filters in terms of shared contacts, and unpacking that. It's really because people we've worked with or people we've co-invested with understand what we're looking for. So that's usually a good channel. For a cold email, as an example, I typically, because we invest at seed to growth, we typically invest post-revenue. And so, highlighting where you are, even down to, where you're at this dollar of ARR, and you've seen a compounded monthly growth rate of X% over the last 6 months, and that immediately catches, I think, any investor's eye around highlighting momentum and the nature of that momentum. Has it all been organic acquisition? Even better if so, because I think a lot of investors, including ours, our fund, appreciate capital efficiency. But again, this is the lens through which we invest. I can't really speak to hard tech in those areas. It's just not our realm. But in terms of SaaS and marketplaces, we really pay attention to the initial momentum and the nature of that momentum. And then there's maybe a secondary category of, if we have an area of interest, let's say it's business in a box or bottom-up SaaS for accountants, and the thesis just happens to align with that area of interest. That might also be another way of getting a response, but that's more, I think, luck or doing your homework, as Peter described upfront, figuring out what areas of interest that investor has.
Okay, cool.
Yeah.
Also for the, oh, go ahead, Z.
I would just add, like, if you're trying to reach someone like me, right? I will look at LinkedIn messages, but I do get a lot. But I won't necessarily connect with you, but reach out. But it's better if you already know Scott, and then Scott makes the intro. That means that Scott thinks that you're probably ready to start having the conversation. So that's a really good proof point for me. For whatever reason you don't get that, you can do a cold, reach out to someone. But it's always helpful to have some sort of definitely have some personalization to say, hey, look, I've noticed that you've done a lot of work in, medical devices, or you're an expert in robotics, or, or to say on a personal level, so-and-so, we know each other in common, or, oh, I see that you're a pilot or a scuba diver. Even that, sometimes more often than not, will open the door for you as well. But keep it super short and ask if it's okay to send the pitch deck. And for me anyway, I find the pitch deck's incredibly valuable. I can scan through a pitch deck very quickly and know if it is a potential fit and whether it makes sense to have the meeting. And if I say it's not a fit, then I'm doing you a favor, that you're not wasting your time in a pitch.
Okay, cool. Also, I just wanted two quick things. We had about 10 or so more founders join in the last few minutes. So if you can put your questions in the chat and not in the Q&A, that would be great, because it's kind of hard to look at both. And also, I wanted to introduce Martin Klechner. He's the co-founder of Riverside Angel Summit with me, and he is also our partner in crime as an entrepreneur in residence at our program at UC Riverside. And Martin has been running an amazing SBIR STTR conference this week. Martin, I don't know if you want to throw the link in the chat in case some of the folks here want to see some of those videos from the previous days or attend tomorrow. But thanks for joining us, Martin, and welcome. Also, you're muted. There you go.
Oh, yeah. Well, it's only been a year and a half, so why should I know how to
That's
use
right.
Zoom now? But anyway, yeah, I apologize, first of all, for joining late. We just wrapped up a workshop with the SBIR STTR Con 21, so you will be getting some additional people showing up. But anyway, I just wanted to make sure that I kept quiet, because I'm probably certain that if I ask any questions, Scott, you probably already asked them.
That's right.
But anyway,
no, yeah.
Z and Peter and Michael, thank you so much. It's indeed a pleasure, and I'll attach faces to names. So that's fantastic, and I'm delighted that you're able to join us. So Scott, if you would like in any way, I can certainly help navigate the Q&A and chats if I can help in any way while you're
okay, cool.
leading the
Thanks.
charge here.
Yeah. So just for those of you that joined late, we're gonna focus on just a bit of a conversation with the investors, and then but please do put your questions in chat, and we will get to them. But right now, we're just going to kind of have a little bit of a conversation, and then we will bring in the questions. So let's go to the next slide, if I can get it to advance here. So anyway, we kind of talked about this a little bit, but I do know that especially at the early stage, we hear this a lot from the investor partners that we work with. You know, so I guess the question to all three of you would be, what are some of the qualities that you are looking for in founders when some early stage investors say, for us, it's almost all about the founders? Can you each kind of touch on that a little bit? Because I think sometimes our teams, especially as you know, if we're bringing startups out of the lab, they may be light in certain areas, like they may have an amazing technical team, but not such a either no or inexperienced business team or vice versa. So if you guys can talk a little bit about the founders and what you're looking for when you make investments, that would be great. Peter, you want to start?
Sure. So I guess there's a couple of aspects. So just founder personality, you know, it's just, you always hear about, you know, the founder who will walk through walls and get shit done. Don't take no for an answer. And so there's a certain personality type that you see they say what they're going to do and then they do it. You know, when it comes to the team, at least for the deep tech companies, we definitely look for what we call balanced team. So technical lead, if that's a CTO, and sort of what do you call a business lead, or someone who's just more customer focused, who understands the industry. And you know what you're going to be selling into that, and understands the problem set in the industry and the players. And then the last thing I would say is, you know, people talk a lot about product market fit, and that's the whole thing of, like, you know, when your product hits a stage where it's like, instead of pushing a boulder up a hill, you're trying to chase it down a hill. It's just things have hit. I think there's a concept that we talk about a lot internally, which is founder market fit. So, you know, the founder has the right background, especially if you're in a tech space, that really lends itself to the company you're building. So those, you know, I guess 3 different aspects that, you know, we think about.
Great, thanks. Z or Michael, you want to?
Scott, should we?
Yeah.
What's the preferred? Just jump in with.
So basically, yeah, I'm tracking the questions, and if I see something that is germane to what we're talking about, I'm going to do it. But then we're going to also kind of hold some of the questions, because a lot of the questions are going to be answered as we go through this this conversation. So
okay,
thanks for asking.
Yeah, I wanted to just know what the rules of the road were.
Yeah.
Okay,
cool. Thanks. So I don't know if Z or Michael, if you want to comment on. Whoops, sorry, I just skipped to the next slide. Do you want to comment on the founders and some of the qualities you're looking for, or do you think it was covered?
Go ahead, Holly.
Yeah, I think it really depends on the stage. So I think Series A, you need to start really seeing a management team in place that's pretty well rounded. At the seed, it's possible that you don't necessarily have to have, you know, really the strong CEO lined up quite yet. But I really like what Peter was talking about the customer focus. So at least you have someone on the team who's really customer focused. And it's really important to make sure that you're open to and you make it clear what the next steps are for you to get to the point where you have a really well-rounded team. Something that I have decades of experience working with faculty entrepreneurs, and you know, that it's really common to have someone who's highly technical who's like, oh, well, I'm the founder, so therefore I should be the CEO. And there's this sense of kind of possessiveness, and that's really anathema to investors. You know, we want to make sure that we see the founders be very open to, over time, be willing to step aside when the right time comes. And so I just want to caution you about that. And really, it's to your own benefit. You want you want to have a successful company. That's the most important piece. So it shouldn't be about the ego. That said, you know, a little ego is not bad. You want to have a certain amount of confidence, for sure. And I love that term of walking, you know, kind of running through walls, for sure.
Michael, you want to add anything on that?
Yeah, I think the founder market fit anecdote resonates, just because I think the founders we've invested in tend to have a unique viewpoint or some sort of secret that they believe to be true if they execute ABC in the next 6 months, 12 months, 18 months, and also having that plan, the sort of near term and long term, and being able to funnel between both and iterate along the way. And then the last thing is sort of having the self-awareness, to Holly's point, around where areas of improvement might be, and how to surround themselves with the right complementary exec team, or just ICs, et cetera, because this is a long game. And so I personally appreciate a combination of those attributes.
And I'm going to actually, since I don't have this in the slide questions, I got a couple of questions that came in from the founders that I'm going to just insert here. One is, would you require representation on the board? What is the optimal structure of a board? So I guess it's a question of, at the seed stage, I know that, some investors will take a board seat, some will take a board observer seat. I don't know if any of you want to comment on that at both the seed stage and the Series A.
I can go first. I would say at seed, we don't typically take a board seat. Ultimately, I think we defer to the founder. At the Series A, where our check size is above 7 million, as an arbitrary threshold, or above 5 million and greater, and we're typically leading the round, we may more often take a board seat. But there have been founders who have also expressed an interest to not as well. So we remain nimble in that regard.
Same here. We'll sometimes take a board seat at the seed. We don't necessarily expect to keep it for the Series A. We don't. If we lead a series or a seed, we won't lead the Series A. And so we want to make sure your company's successful. So also the other thing is, I think it's a little unconventional. I'd be interested to hear Michael and Peter's perspective on it. But at the seed, we really want the founder to have a really strong set of advisors, and to set up a board. We might have a board of 5 folks, a bunch of independent folks that can help support you. And also to make sure that you take advantage of that board. It does not make sense to have a board if you're not going to be using it effectively, and that's a whole other story and probably beyond the scope of this. But it's not uncommon for it to then get reconstituted as the Series A.
The only thing I'd add is, at the seed stage when we come in, we've seen a mix. I would say if there was a trend line or consistency, I would say, and it's not always true, maybe first-time founders who might need a little bit more guidance, especially when, how do we prepare for the Series A? We've seen a bit more where either we'll take a board seat or someone else who's leading will. A more experienced founder, maybe it doesn't necessarily need that. But we've actually found some early stage founders, first-time entrepreneurs, actually want a bit more guidance on the board because they know they need to be well prepared for the Series A. But we were pretty flexible there as well.
Okay. Another question that relates to founders that just came in. This is from Hunter. Is there any specific advice you would offer to women founders of tech companies? Any strategies to overcome unconscious bias? If any of you want to take that in terms of how
let me let the guys answer that first.
I was going to say, I definitely don't want to say, Z, why don't you answer that? Because why don't we
And I have to because I also have to close my window because I have a mobile car wash just seemed to have pulled up in front of my neighborhood.
Okay, all right.
I'll be right back.
Okay. So Peter and Michael, do you want to talk a little bit about how you your firms think about that, and we can probably expand that to beyond just female founders, but also underrepresented founders as well. We, as you probably know, in our region, focus on mentoring and working with a lot of underrepresented founders and female founders. So anyway, this might be a good time when we're talking about founders and teams to talk about that.
Yeah, I mean, I guess I can jump in, and definitely not to downplay the fact that there are issues out there in the industry. I don't know. I think for me and our firm, we've never even thought about viewing a female founder differently. I think on the deep tech side, just based on volume, there are more male founders. But I would say probably 20% of our founders and companies have a female, founder. And so I don't know, we've never talked about that internally as, somehow there should be something that they should be doing differently than a male founder. But I'm a male, so maybe I am also not being as cognizant of some of the things they go through. But when we assess the company, we have female founders who are killing it, and male founders, so we don't really make a distinction.
Okay, cool. You want to add anything, Michael?
Yeah, I do recognize that the unconscious bias is certainly definitely a consideration. I think I'm always recognizing that I'm guilty of that in all arenas of my life. But to Peter's point, I do think that we, really it's the first filter before we take the first call is really centered around the market and post revenue and the traction. And then everything else kind of comes after in terms of the product, the competitive landscape, the founder's experience and background in the market, the unique insight that they've had. And so it's not really been the gender or background of a founder hasn't really been a consistent topic when we assess a business, given how we view the opportunity.
Okay, cool. You want to add anything, Z?
Yeah, and I'll say that I don't know exactly why, but almost 80% of our founding teams have a diverse founder on it. 40% of them have female CEOs. About 40% have CEO of color. And I think part of it may just be we've specifically really cast a wide net. And I think also because it tends to be that people feel more comfortable pitching someone that looks like them. And also it's possible that we all have our own conscious, I think it's just been shown psychologically that you tend to relate to people who look more like you. It's not necessarily a good thing. It is what it is. But I think I wonder if it makes sense for also just there may be an advantage to pitching someone who looks more like you. I don't know. At the same time, it's important for that person to be when possible, that person be a decision maker within the firm. So I would caution you against approaching a person just because you think that they look like you, therefore they're going to be more likely to invest in you. Look at who's the right person within the firm. And I don't really know the answer to that, but it is an issue. And I do think that some, and it's been shown that these days, female-led startups have been having better performance recently, and they're rocking it in our portfolio. So I agree. I think that they're a great investment opportunity, and not all venture funds will be as open-minded as the folks on this call.
Okay. Yeah, that's good. Those are good answers. So we got a lot of questions that are coming in around specific verticals and other things. I think we should save those to a little bit later and get to a couple of the other things, because I think you're going to have, for those of you that are asking those questions, you're probably going to have those questions answered here in the coming slides. So the next question we're going to get to, and this is something more for a little inside baseball, I guess, but I do think that, again, I have had a number of founders contact me and ask me to introduce them to funds that aren't currently investing, because they have not done the homework to understand that, maybe the firm is out raising their next fund, or maybe whatever. But do you guys want to talk a little bit about what dry powder means in your industry, and also about venture fund cycles? And we don't need to go too long on this. I just want to make sure that, especially the new entrepreneurs, the first time founders, understand this. So anyone can take it who wants to talk about that a little bit. Or I can take it. No, Michael, you want to take that one, since you guys have, or Z, or whoever wants to take it. I just think just to give a quick overview of what that means.
Go, Michael, and I'll tag on.
Okay.
Sure. Yeah. So we're currently on our third fund. Fund 1 launched Q4 of 2017, and Fund 2 launched Q2 of 2019, and we started investing out of this current third vehicle April of this year, and then along with our first growth vehicle. And I in every first meeting, I sort of state the start of when we started investing on the current vehicle, because to this exact point, so that the founder knows that we are, actively investing and not at the tail end. The venture fund cycles, this is sort of above my, I think, experience level, because I've only been in venture now 5 years, but I think the fund cycles seem to have accelerated, and funds are now raising capital and deploying capital much faster. And those are, there's other sort of macro tailwinds behind that. But the point here is that try to find, and it's hard to suss this out, but ultimately you need to get in front of the investor when they have the capital to invest, and they're not sort of in a position where they're currently fundraising from their LPs, and may not yet be in a position to fund when you need them to. So how I might be able to test that out is really just asking that you can ask the investor up front. You can ask founders who have met them previously. You might be able to ask their portfolio companies. But I don't have a good answer or silver bullet. There's no like source of truth where this is publicized, at least to my knowledge. But that's my quick take on that.
Thanks. That's good. That's a good answer. Z?
It might be worth just mentioning for those that don't know how venture works. So we talked about LPs and how limited partners will invest in your fund. You have 10 years. We, as venture capitalists, generally have 10 years to invest that money and then get the return. And it can be extended by a year or two, but there's a clock. And so usually it gets invested. You end up investing the first, 2-3 years, and then you're hopefully reaping the rewards and dealing with all the bumps along the way. And so as soon as you've invested your first, in the first couple of years, like you're already, it's like the first, you've closed your fund and now you're raising the next one. It's constantly. So if you think as a founder, it's hard to constantly be fundraising because that's your job as a CEO, venture capitalists are doing the same thing too. And most people don't realize that that's the reality. And so I really like the term dry powder because it is a very upfront way that you can ask people like, okay, how much dry powder do you have? It is a phenomenon. There's a few things that you definitely want to keep an eye on. So sometimes there are VCs out there that are a little bit, they're out of dry powder, but they still have VC partner on their, business card if they had a business card. And they kind of use the opportunity for it to just feel relevant and still have meetings. And that's a problem. You don't want to waste your time with folks like that. And even worse problem, and this is something I've seen twice in the last just over a year, and it is surprising how few founders, even savvy founders, realize this or think about this, is that there are times when you're raising a fund and you may, as a VC, there's some VCs out there that might be raising a fund, see some deals, they get so excited and they're very close. They see that they're very close to their first close on, getting the money in from their LPs, and they'll give you a term sheet and they don't even have money to invest in you. And I've seen this twice recently where they almost tanked the startup, because once you take that term sheet, then you can't take a term sheet from another VC for a certain amount of time. And you may lose opportunities. Plus, if that round falls through, then all of a sudden people wonder, why did you not close that round? And why are you out fundraising again? I'd be curious, Peter and Michael, if you've seen this as well, but I've seen this a couple times, and you have to be super careful as a founder. You make sure that you know that they have at least done a first close and they do have the dry powder to invest in you when they give you a term sheet.
So I have not seen that happen yet, but I guess it doesn't surprise me in this environment just because there is a lot of money flowing and there's a lot of expectation. The other piece, I think Michael said, just like, you should just ask. I mean, the entrepreneurs, don't be shy. I mean, you're pitching your business, you can ask the fund, where are you? How much money do you have left? How many deals? Things like that. The other piece is just, it is a rear view mirror, but like, when was the last deal that you either led or was, not a follow-on investment for? Because follow-ons are very different from initial investments, because a lot of funds keep reserves and they might quote unquote look like they're investing, but all they're doing is re-upping in existing companies. So when's the last time? And if it was hopefully recent, very recent, then, obviously, I guess there's a question if that's the last deal in the fund, but hopefully they are staying active. But I would just say, ask the question.
Yeah, they don't necessarily have to be leading. I mean, it could
Right.
be first check, right?
Right,
That
first
is
check,
an
yeah.
important point that you have is that that a smaller percentage of the fund, you may have $100 million fund, but I don't know exact numbers here, but you may have 30 million that you're investing, but then the rest is follow on checks because you get what's called hopefully as an investor, you get pro rata rights, meaning that you can keep your percentage in the company by continuing to put money in it subsequent rounds. So they don't actually have $100 million to invest first checks in companies. So the actual
That's a great
amount-
point. That's a great point. And that a lot of founders are actually confused by that. And so I think this gets to the probably the question that everybody who's tuning into this is going to ask is my startup ready to raise capital? I thought that we could this will get to some of the other questions that have come in. But I thought maybe we could cover this. And I know that's a broad question. I have actually a couple other slides that dive into a little more detail. And obviously what I try to do is I try to put together thresholds from the, whatever 60, 70, 80 plus investors from both that includes, of course, angels and funds that we know and work with. And so this might not apply to you guys. So I just want to go through a couple of these things. So can we talk a little bit about what traction means for each of you as investors and also for your funds? Because I think there's a confusion in terms of what traction means. And I know it depends on the vertical. So maybe we could talk about an example that, that Z has seen. Maybe we talk about an example that Peter's seen, and then maybe one that Michael's seen of just, what kind of traction are you looking for in key verticals that you're interested in investing in? Whoever wants to start.
Anyone else can go first.
Okay, Peter, you want to start?
Sure. I mean, so I guess broadly, at least early stage, you should probably segment pre-revenue, pre-customer and post-revenue, post-customer. And so there's a smaller segment of VCs who will go pre-revenue, pre-customer. And you should just do your homework to figure out who does that based on prior investments. And then target accordingly. And so there's not a consistent level of traction you need. For us, because we are deep tech and we are early stage, I think we have 22 companies in the portfolio. 20 of them, when we invested, were pre-product, pre-customer, pre-revenue. So we are fine going early because we understand that a lot of these hard tech companies take a lot of capital to even get to market. So for us, we have a different criteria around, because we do hard tech. We spend a lot of time in diligence understanding the difference between R&D risk and engineering risk. We are not interested in R&D risk. If you're still trying to figure out the physics and the chemistry, then go raise grant financing. Once you understand it, and now you are now productizing that, we are comfortable with taking that engineering risk. So it really just depends on the sector, on the investor, because you will get investors at all stages that have different criteria. But yeah, that would be ours.
And that's an excellent answer because we have a lot of deep tech companies. And I think I know there's confusion in that R&D risk versus productizing risk. And so David, I think that answers your question you had put in, which was, are the investors willing to assume technical risk for deep tech technology startups in the energy space? So I don't know if you want to speak, anyone wants to speak specifically to the energy vertical, but it sounds to me like Peter just answered that question. It's going to depend.
Add too,
yeah, go ahead.
There's a third level. So I agree with Peter. We will also, we're not going to be investing in research projects, but when there's some engineering risk, we want to try to mitigate that as much as possible, especially in the energy space, but in many spaces. Scale up is another risk. So you may have, you may have a feasibility study, you may have the science proven, you may have a prototype, you may have your first product. That doesn't necessarily mean that what you have could scale up to, megawatts or, so there's definitely this, every order of magnitude is just harder. And so we would like to see a path to reducing that scale up risk as well.
Yeah, that's a good point. Michael, do you want to give an example of the kind of traction you're looking for in your investments? Just generally, I mean, I know you do a lot of verticals, but just maybe a B2B SaaS example or something would be a good example.
Sure. Yeah. So I would say we definitely skew more often post-revenue, post-product launch than pre-revenue. And just to throw out kind of levels to make it more specific, the market is kind of moving, but I would say somebody raising a seed extension, call it 3 to 5, 6 million, might be in the ballpark of somewhere between 600K annual recurring revenue. And it's also the time frame during which they took for them to get to that point. And the numbers really are, I think, more what comes with it is the interesting data set, which is like the customer engagement, the user and revenue retention, and the nature of that acquisition. Once you start getting into the, I would say 100K to 200K annually recurring revenue tier, there's usually enough of a data set for us to extrapolate potential product market fit. Now, if you're pre-revenue and we have an affinity for sort of companies with a self-serve, there may be some engagement metrics we can look at, whether it be the conversion from your freemium or free trial percentage of that conversion, or daily active users as a ratio to monthly active, similar to weekly active as a ratio to monthly active. And these are all secondary signals that we also look at to infer product market fit, as well as like qualitative, customer references, friends of ours who are at other companies who may be using, product later at the later stage. It's pretty self-explanatory, with those metrics. But once you start getting into that tier for B2B SaaS and for marketplace models, there's usually enough of a data set for us to unpack.
Yeah, that's great. And this slide this is just some, and this, may be incorrect data for your specific, what I try to do is I try to blend different answers from different investors across a number of different verticals, just to give founders the sense of what kind of stuff they're looking for. Because for example, if an investor is focused on a SaaS business that's doing 250K a month, you might not want to waste a lot of time trying to network yourself in to talk to those investors when you really should be going after an angel or seed funding group. So I do think there's I should stop saying I think there's a ton of confusion amongst the founders in terms of what traction means. And, so I try to break it out here. And again, these are just some examples. This doesn't get into deep tech, but I think Peter and Z both gave great answers on some of the deep tech startup things that you're looking for. So I know we have a mix of founders on this webinar that are across all the verticals. So anyway, we can obviously, and I try to keep this updated and add to it. So we can talk offline if you guys want me to, if the investors on this panel think we should change some of these metrics, but this is some of the stuff we kind of share out just to try to help the founders.
I feel for deep tech though, it's different, and I'd be interested to hear Peter's perspective. But
yeah, it's definitely different. Yeah.
Yeah. So at seed, I don't expect to see revenues, but I do want to have you may have some NRE, non-recurring kind of engineering costs. That you may have a relationship with a customer that wants you to do a little bit of work for them to do something customized and maybe do a proof of, like a prototype for them. That's great. Or have letters of intent, having conversations with folks that are customers that are very interested, and they can be very clear about what kind of endpoints for them to become customers. And then that way, one of the most important things you can do, and when you're raising your seed, is to be really clear on what you need to show the traction you need for the Series A. Series A, you need to start usually, unless it's medical devices, it's different, but you need to have some sort of revenues. But so having those endpoints really, really important. And the last thing you want when you're raising your seed round is to have too little money and not enough runway beyond the point you think you're going to have to. So you have some contingency plan. So you're not building a bridge to nowhere, and then you're not going, desperate to get a bridge. So be really clear, and having any startup, any entrepreneur needs to be having the conversations early with potential customers, understanding, because otherwise you're not getting to product market fit. So I want to see that. I want to see, who are you talking to? What are they telling you that you need to get to in order to actually get them as a customer?
That's great. One quick question before we get to this post money, the way the start, we get this question a lot, and we try to coach the founders on this type of funding. But before we get to that, I just have a quick question from Arash about patents. So he asks, when do you like to see a patent, or at least a patent pending, for B2B SaaS companies? Is there a lot of conflicting views for investors if software companies should patent software / algos, which would be algorithms? Anyone? I don't know, Michael, does that make sense? Do you want to try to take that one, or?
We don't, at least in my time at Craft, we don't really focus on the existence of patents, or what the thought process is around a patent. It's really not a commonly, it's not a common consideration for us. Full stop.
Okay.
Like especially for B2B SaaS companies, maybe more in the sort of deep tech, frontier tech world, but definitely not for B2B SaaS companies, at least for us.
And then he had a follow-up for you, and then I'll get the opinions of Peter and Z on the patents for deep tech. But David, he had a follow-up for you, which is, would you have considered companies such as Monday.com, HubSpot, or Slack in their early stages as having defensible IP?
Yes, is a short answer, assuming that the metrics kind of were directionally supporting that thesis for us. One of my GPs, actually, David Sachs, who started Craft, has a Substack, which I just responded to in the Q&A. I'll put it here in the chat, and he actually titles it Bottom Up SaaS, and he goes into some of the metrics that we break down, specifically for one investment, actually, Scratchpad, which is a tool for sales reps who are using Salesforce as their CRM, and broke out the sort of DAU/MAU and ARR metrics that we looked at, and then sort of inferred to get to conviction on, to ultimately believe that there was a moat early on. And so I think reading that is a good resource to understand how we might unpack a B2B SaaS business.
Yeah, I actually have read that, and I would recommend that to any of our B2B SaaS startups. And David Sachs does some amazing writing, actually, and he writes in a very variety of places, but that's probably the best place to go to where it's all contained. He's also on a podcast with Jason Calacanis and Chamath and some others. And so anyway, there's a lot of great info out there you can get directly from investors who are public about how they think about things and how and why and how they invest. So thanks for putting that in the chat, because I think that, again, many of the founders that are in those verticals should go read what David Sachs has to say about that. Peter, do you or Z want to add anything about patents and IP? Deep tech, is it critical for you to make an investment to have a patent pending or some type of patent protection, or not?
I mean, at least from our perspective, we don't see a company succeed or fail based on their patent strategy. Having them is maybe a nice to have, but I think our diligence is with the assumption that everything can be replicated, and it's just what kind of head start do you get. So I would say teams that are overly focused on thinking that patents will save them does not hold true to us. But I do believe that when you have the funding and depending on the application, it can be helpful for asset value. And later stage investors, acquirers will want to see it. So I don't want to totally downplay like, oh, patents aren't important. But when we make our investment decision, it's the patent strategy is a very small, tiny element of what we assess. If we decide to invest, then we'll talk about what we should or shouldn't do and how much we should spend time on patents. But that, I would say, has almost no effect on how we make our decision. There's so many other things that are more important.
Yeah, I'll agree. I mean, I think that it's do what you need to do as a company, right? Don't try to do it because you think an investor will want to see it, right? Because the investor wants you to do what's right for your company. In a lot of these companies, it's really about execution and speed. That said, IP does tend to be very important for us, and don't mistake IP for patents, or IP for patents, right? So there are many other forms of IP. know-how, or it's really, and your protection strategy, there's different ways of protecting it. So I think that having folks on your team who really know how to do stuff that's differentiated from other folks, that's IP. And whether or not you patent it depends on the situation, and whether you can patent it, whether you can copyright it, et cetera. But that's less important than the fact that you have that IP. And that you have the freedom to operate too. That's another thing. It's not just a matter of protecting other people from infringing, which is one reason you get a patent, but patents don't give you the right to practice your invention. So that's another piece of it, is we need to make sure that you have that freedom to operate and that you're not infringing on other people's IP.
That's a great point. So let's talk for just a couple minutes about, there's definitely confusion out there. Many founders will watch a Y Combinator demo day and then automatically assume that they should do a post money safe. Some founders who probably could have done a post money safe will do a price round, which may or may not. We can obviously argue the pros and cons of every one of these ways to raise capital, but just from your perspective as investors, do you at the pre-seed or seed round, do you like or dislike, or do you do post money safes, et cetera, et cetera? If we can just touch on that for a second. I know a lot of our founders had questions about these three.
We do at seed, and we have done the YC post money safe at stages beyond seed as well. And ultimately, it's as a result of a conversation with the founder and their preference. The trade-off being, they avoid the legal due diligence and the time it would take to run through the legal DD for a price round. And so we're comfortable with the YC post money safe, and we just use the template straight from the YC website.
Okay, cool. Any other thoughts from Z or Peter?
Same. I mean, we tend to lean towards price rounds because then you know what you have. And I feel like if we lead, we have a pretty good idea of what we think the value of the company is. And then there's value in knowing what the value is. But it does slow things down and it does cost more money. So we're happy to go with the safer con note if that's preferable at the seed. By Series A, we're doing a price round.
Sorry. Okay, cool. Peter, do you want to add?
No, very similar. Yeah, we're pretty flexible. It depends on the situation.
So one thing though that I think that some of the founders also are don't know that much about, and something that we may want to touch on for just a second is syndication, and also what it means to be a lead as an investor, and what it means to just, again, this is more for the early stage, obviously, but if anyone wants to just touch on that. We have a bunch of questions that came in about do you lead rounds? What do you think about syndication, et cetera, et cetera. So if anyone wants to start on that question.
Well, I can explain what it means to lead.
Yeah.
Anytime you have a round, if it's a price round, you need one investor to say, this is what we think the price should be. You may have more than one offer, but you pick one and they become the lead. And then they may take the whole round, but often they don't. And then you bring in other investors that co-invest with, in that round. So in our case, we're happy to do either. It depends often on how well we know the space. So if we don't feel like we really fully understand the space as well, we may wait for someone else to take the lead, and then we can have the conversations with them and do some more due diligence, et cetera. It really just depends on the situation.
Okay, cool. Any other thoughts on, I assume that all your firms are open to syndication, and I know that each of you lead some deals and then syndicate other deals, so or allow syndication in other deals. So I guess it's just, again, it's a case by case basis, and the founder should do their due diligence and on you guys and understand, because some of the smaller firms that we refer out to for our deal flow out to, they typically don't lead, and so we need to then find a lead and then go back to that investor, and then they'll write a smaller. So like we just, a couple of them we just closed rounds for. Like we found a lead to do $1 million, let's say it's a $1.5 million seed round. We found a lead to do $1 million, and then we went and we put together one $250K smaller fund, and then a couple of angels, and then we filled out the $1.5 million round. And it was a anyway, you get it. So
But I will
So
say
I guess
that the
that's
work
just,
that you do when you
yeah.
find other investors that are really eager to come in, it makes it easier for us to say, oh, look, if we lead, let's say it's a 1.5 million. Sometimes here's an example, they're $1.5 million round. We ideally want them to raise 1.5 million, but we feel like you absolutely need to have at least $1 million for you to get to the next milestone. So we will close for that 1 million. So that's another thing that's worth considering, is like, what is it that the minimum that the investor feels like I need to make sure, we'll invest 500, but we're not going to close until you can raise the other 500K. So if you've already what's called soft circled another 500 or more K, then that makes us feel confident. Okay, we'll give you the term sheet and then you can pull together that round, and then given a certain amount of time to then extend and, come up to the 1.5 million.
That's cool. That's helpful. I wanted to do a little bit of a discussion because I know that we're going to lose Michael in a couple of minutes, but I wanted to just say, the startups that we're mentoring that we've been helping, and we helped raise a seed stage, who are now going out for their Series A. I do feel like there may not be enough awareness around the massive drop off that's happening between, and I've seen different numbers, so I don't want to quote the wrong numbers, but let's just say there's 40,000 seed stage startups getting funded, and there's like 6,000 Series A or whatever in any kind of time period you want to do. And again, we can get exact numbers, but it's definitely not 1-to-1, as we all know. And just like it's not 1-to-1 for Series A who raised Series B, we get that. But I don't know, Michael, if you wanted to say anything about this, and maybe just some thoughts on what the founders who have raised their seed rounds and are now going out for their Series A, anything they should think about, or any strategies?
So what I do with our portfolio companies is in advance of going out for that downstream, that next round of financing, call it whatever letter or stage it may be, do three things: compile that investor list based on the homework that we've all alluded to, target investors who potentially lead, in my opinion, and then spend time with those who follow on. So that's the first bucket, is build your investor list based on the criteria that would match what you're looking to solve for. The second would be, compiling your data room, which is usually something that would exist for a company closer to Series A stage. The data room should consist at the bare minimum of your deck, as well as, sorry, my camera just is wonking out here, but the data room should consist of your deck and your historical financials and other KPIs that you think might be relevant, as well as maybe some screenshots of the product, other aspects about the business. And then the last thing is just practice that pitch and narrative that ultimately will come from that preparation. So those are the three big categories that we definitely support our portfolio companies through. And I think that is a good way to prepare, especially for the Series A.
Any other thoughts from Peter or Z on that question or statement?
I mean, as an investor, when you invest in the seed, it's super high risk. And that's why you get a premium, and the valuation is much lower when you invest, because you're hoping for that inflection point, and it wouldn't be so, yeah. So that's why you get that great valuation, is because you're taking a big risk. So there's going to be plenty of companies that won't make it to the Series A. I just want to reemphasize what I mentioned before. The importance when you're raising a Series seed is that you know what those milestones are going to be. So it's one thing to not meet them because something happened, and that happens, right? The failure that should not happen is that you didn't have appropriate milestones. So you need to, even when you're raising the Series Z, you need to know where you're going. And then finally, I would mention that there's the Alliance for Socal Innovation has this thing called the Socal Venture Pipeline. So if you really truly are ready for the Series A, one of the things is like, how do you find the right investors, and how do you get those introductions? If you're truly ready, then I really encourage you to apply for that. I will look up the URL and stick it in there, because then they will help make those introductions for you. Because we want to support. I've been a community lead for them, and we want you to get that, raise that money, and you may not know all the investors.
Yeah, that's a great point. And so Z and I are both community leads for that project, and we are trying to unlock more Series A capital for our region. And so if you are ready to raise Series A, or you think you are, then definitely get in touch with us and we can help you out. So I think we'll move now to a couple of the more specific questions for all of those that are either texting, emailing me, or putting in chat questions about what these folks invest in. Please just go to their websites. I don't want to take time asking them those questions, because you can go literally see that on their website in about 30 seconds. So let's focus on some other questions quickly. Rainier asks, many funds are recommending that he join an affiliated accelerator in order to get on their radar. Is this 90% of the path to success? Question mark. So accelerators, yes, no, indifferent. Peter?
I mean, they can be helpful. I think especially for first-time entrepreneurs who could use a lot more guidance. Maybe you're not quite ready to raise a full round, or you can't convince an investor that you're at that stage. I think, you know, some accelerators do a good job of really making sure you line up what are the milestones you need, what's the pitch, we're really honing in on the market size and the customer pain point, all these things that are just sort of bread and butter for what a VC is looking for. For some founders, it might not be quite as obvious. So I think they can be very helpful. In terms of the specific question around, like, some VC funds are sort of steering you to an accelerator. I mean, they're basically saying it's a pass right now, but maybe we see a gem of something there that could turn into something. So rather than a hard pass, we don't need to talk, maybe go to an accelerator we've had a relationship with, and then, 6 months from now, maybe you're ready. So, I mean, I'll take it as a positive that at least there's a next step and not just a pass and there's no interest at all.
Right. Okay.
Yeah. I mean, that's usually what it means in my case too, is there've been deals that I thought were a little too early for us, or that I didn't feel like I could give the kind of support that they needed, because it might've been a slightly different industry where I have connections, and I do feel some of the Techstars accelerators are excellent, and as for an example, and I think that in my opinion, I find it a red flag. Sometimes entrepreneurs will say, we've been through all 4 of these accelerators.
Right,
That's
right.
a bad thing. It's like,
Right.
wait, what? The one wasn't enough? But one is good, like if you've been through one, great. But that's not a selling point. It's more like that's how you connect with new investors. It opens doors. It also, more importantly, or at least as importantly, it connects you with potential customers, mentors, different market insights. I think it can be really helpful, and other fellow entrepreneurs, especially we're still in pandemic where it's really hard for us to connect with each other. It provides opportunities for serendipity. So I recommend 1 or 2.
I think it's
but don't brag about it.
Yeah, I think it's a great point. And we have a follow-up to that, which is we'll ask in just a second about crowdfunding platforms. But first, Spiros asks, does grant income post-investment with operational platform count as traction? I'm not exactly sure I understand that question. I think what he or she's asking is, would you consider grant income as traction? And I think for deep tech, well, you guys should answer, you're investors, but anyway, yeah.
So we definitely have companies that, pre and even post are investing, they apply for grants. We don't view that as a milestone. We view that as extra capital to extend runway. Your milestones are generally customer driven. So yeah, it's just, hey, if you can get some grant financing and that lines up very, very well with your product roadmap and it's not going to distract you, we just bought ourselves another 6 months. That's great, extra contingency. But it doesn't mean you hit a milestone that a Series A person will say, wow, I'm ready to invest. Those are very different kind of milestones.
Totally agree. And I'll also add, so we love non-dilutive funding for sure. I'd also add that there's a difference between, for us anyway, commercial customers versus government customers. We find that we generally like to see a path to commercial customers. And if you're at Series A, that you actually have commercial customers, not just the government. Not that we dislike the government as a customer, it's just it's a different market. And that's not an area where we play as much.
Okay. looks like we have two questions here from Mark. First question is, let's take them separately. First question is, what is the panelists' take on Greylock and Andreessen's new seed funds? I'm not sure. I mean, I think the more capital we've gone into startups is probably the better. I don't know if you want to comment on that. I guess the question may be, with bigger funds coming into pre-seed and seed, is that something that smaller funds are worried about or concerned about? Maybe that's the question.
I think that these bigger funds are starting to recognize that it's there's a lot of value in investing later, but the market is so hot that in order to get a foot in the door for that later round, they sometimes need to get that early investment in. That said, that doesn't mean, just think about somebody who has $1 billion under management. They're not going to have the time to support you. So I think my recommendation to founders is to pick your lead very carefully. You want to make sure that the lead is a firm that is going to work with you and support you and give you your time. And don't just take the firm's word for it. I love it when there's a potential investment, they do due diligence on us with our other portfolio companies. That's a great sign for me, so I recommend that. But I think that so they're not bad, they're great, right? But I think that they don't play the same role that the smaller funds play in the ecosystem.
Yeah.
You want to add anything, Peter?
Yeah, I think that's right. I think if there's the negative perspective on why are they doing this, it's they're worried about missing out. It's sort of a placeholder they can hold so that they get an inside look at the next round before it becomes way too competitive. And if there's a negative result is the signaling risk that people talk about. Big fund comes in early. If they don't invest in the next round, which is their more typical round, well, they had an inside look. What's wrong? What happened? So I think there can be negatives. But I'm also the last person to tell an early stage startup turn away money. Like I'm not going to tell you, oh well, there's all these risks. Don't say yes to this fund is going to give you money.
Right.
You got to do what you got to do.
Right.
But just go
But
in knowing the risk.
It is true that negative signaling, if you have an investor that doesn't then invest in the next round, or if you have several, then it starts looking not so good.
Yeah. Oh, yeah, that is that has actually happened, unfortunately, to a couple of the startups we've mentored. Okay, so did we get this question literally multiple times a week? Just yesterday, actually, I talked to two founders about this, and that question is, what is the panelist, what is your take on equity crowdfunding platforms such as Republic and Start Engine?
Republic is one of our portfolio companies.
I was going to say, I was just going to say, Z might not want to comment on that
conflict
one,
of interest here. I can't say.
Yeah, exactly.
Peter,
I knew that they're one of your portfolio. And also, I just want to disclose that we've worked with Republic and a couple others, and we've had positive, I would say good and not so great outcomes. So it's been great for some of the startups who've raised the round they needed to raise to get them to the next level. And then they subsequently are now going out and getting institutional investor interest. And then some it's not. So it's kind of like Kickstarter and Indiegogo were back in the day in a way. But Peter, you should probably comment on that.
Yeah, I have limited experience with this. My take on some of this is, it helps for marketing. So if you have a consumer tech company, you can identify early customers. Maybe it's a little bit easier to market and tell the value prop of what you're doing versus something that's deeply industrial. I worry that, anytime you have valuations because you want to take advantage of maybe free flowing money that you set yourself up for later round, that could be, maybe not as helpful. But to be honest, I don't have enough of an experience set to say, to make a judgment. But I do feel like in the grand scheme of things, they're positive. I think you just have to find the right situations and the ones who can take advantage of it. And it really lends to customer identification and getting the word out. It can be very helpful.
Yeah, I've found, oh, sorry, Z, go ahead. Were you say something?
Well, I will add that I have actually less experience, believe it or not, with like Start Engine and Republic actually. But worked with companies that have startups that have worked with Kickstarter and Indiegogo, and I see those are really, as Peter said, more consumer facing. They're a great way to show market traction. So to me, it's less about the fundraising and it's more about, wow, all these people are willing to pay for the product up front. That's a great sign. And it's also good to complement VC funding as well, as opposed to in the same way grants can extend. Yeah.
Okay, cool. Yeah, I'll just add one thing. I do think that because I do have some experience in consumer startups, having done some, and I will say that, and also some friends that, and I don't know if this is going to be the same with Republic and the equity crowdfunding platforms, but with Kickstarter and Indiegogo, if you didn't completely crush your goal, like let's say your goal was to raise whatever 250K, if you didn't do like 2 or 3 million, then it really literally killed you in the fundraising for Indiegogo and Kickstarter. Now that was a few years ago and that might be old news, but I don't know what happens if you're a startup that goes out on an equity crowdfunding platform like Republic, and let's say your goal is $1 million and you raise 100K. Now, to me as an investor, that might not be the best signal to when you go out to try to raise money from a pre-seed or seed stage VC. I don't know how you guys think about that or feel about that, or if you've even experienced that yet. But if a startup had been on, we'll just say, we won't call out them specifically, but an equity crowdfunding platform, and they had let's call it a suboptimal raise, would that affect your decision in the deal evaluation?
I will mention that it's a lot of work to do crowdfunding. So don't underestimate that. It's not necessarily the easy way to fundraise. So side note, but I don't think it would necessarily harm their chances with us, just because we don't focus on startups that depend on a lot of branding. And so if we did, then it would absolutely be critical to see that you can pitch in that kind of an environment to the broader market. But in our case, it depends. I would say, like, well, who's on this platform? Do they really understand this particular weird industrial application or whatever? And I don't know that it's that great of a signal one way or another. I'd use my own judgment over that. So it really depends.
It's a great point for deep tech startups, especially. So, okay, cool. Rebecca has a question. To the point of pandemic and difficult to connect, what is your favorite way to connect, or a novel way someone connected with you instead of Zoom? It's an interesting question.
Zoom's amazing. I mean, to be honest, like, when the pandemic hit, I was like, oh man, once it got really bad, I was like, oh, I don't know what's going to happen with the funding. And then in 4 months, I personally did 2 new investments completely on Zoom without having met the founders. And I was surprised at myself because I did not expect going in. Now, it doesn't replace face-to-face. I think, if I look back, I would say there were probably shorter, but many more interactions on Zoom than in person, maybe longer sessions, but fewer. So that was sort of maybe some of the trade-off. I think it's great for top of the funnel. It's much easier for me to do a quick 30-minute Zoom and get a sense of, hey, are you just broadly the right fit or not? And then once we go into diligence, hopefully, we can do in person, sooner than later and dig really deep. But I don't know if I've seen anything that is like sort of super creative or different. Yeah, that'd be my take.
Are you saying you don't want to be stalked at your place you get your coffee or your gym or whatever? Are you saying
yeah, we've had some weird ones. We had someone discover our Wi-Fi by walking down the street and then I don't know, just but yeah. Yeah, I don't know if that stuff works.
Yeah, exactly.
I think serendipity is really important. And so it's not really a matter of how you end up having that meeting. I mean, you could conceivably do whether it's a beach walk here in LA or, I forgot that, up in Palo Alto, you could do the dish walk, right? But I think it's more a matter of how do you connect with people. And I think that at least in my case, I'm more receptive to new connections when I'm in the mode of speaking at a conference or mentoring for Techstars or something, because then and then we have some mixers things, and some of those are online, a lot of them, I mean, over the pandemic. And I think that, but I'm in that mode at that moment. So I definitely, in fact, yeah, a few of the startups that we've invested in, I've met through, whether it's Techstars or a conference that I did, Venture Summit, and I did not meet them face to face before, and it would have been hard to get my attention outside of that circumstance.
I think that's a great answer. And I think we've taken up enough of both of your time. So I think we should wrap. I'm just going to give one more slide here, which is just our contact info for our program. If you're a startup in the region or coming out of one of the universities in the region and you want the help of our program, please let us know. And that's our contact info there. And yeah, we of course want to thank Peter, Z, and Michael for their time. This is really helpful for our startups, especially our first-time founders who don't know the answers to a lot of these things. And yeah, as always, thanks for supporting our ecosystem and our entrepreneurs. And also, I want to personally thank you for, as Z said, I think, and Peter might have said earlier, they have actually looked at some of the deals we've sent of startups that we've mentored, and we appreciate that as well, because without great investor partners, we're not going to be able to help these startups scale. So thank you for all the support you've given to our startups that we've recommended to you guys as well. So, and also thank you to Martin for helping us put this whole event on, and also SBIRCon. And to the startups, we look forward to continue to working with you. Please come. We have a bunch of other workshops similar to this going on in the coming weeks. We're going to talk about, Martin, what is it? Next week, we're talking about cap tables, valuations, and term sheets, aren't we?
Valuations and term sheets next week.
Okay,
another
cool.
rock solid panel. Thank you to you both, and thank you to Michael. Absolutely phenomenal information. We really appreciate you taking the time to join us.
Definitely. And for those of you that have applied Riverside Angel Summit and have just kind of not really done a great application in terms of an updated pitch deck, et cetera, we are making the cut down to 24 in the coming days. So you will be cut if you have not put in a pitch deck and other stuff. No matter how much we love you and how much awesome we think you are, you got to put the stuff into Gust, which is our CRM for this project. So please put it in, or you're going to be cut and you're not going to make the final 24, or not the final, excuse me, the next cut, which is 24. So that's just a little end note there for those of you that are involved in Riverside Angel Summit. And thanks to everybody. And we will see you all next time. So everyone take care.
Be safe.
Thanks for having us.
Take care.
All right.
Bye.